Why are so many people falling behind on their credit card payments? What are the economic pressures that we're facing today, and how are they influencing our financial habits? In recent months, we've seen some alarming trends in the United States economic landscape. Credit card delinquency rates, that's the number of people who can't meet their monthly credit card payments, are at their highest since 2012. This information comes straight from the Federal Reserve Bank of Philadelphia. And it's not just a slight increase, it's significant. This rise is largely due to two factors: persistent high inflation and interest rates that continue to challenge consumers. But it's not just delinquencies that are on the rise. Overall credit card debt is skyrocketing too. In the last 20 years, credit card balances have shot up from $700 billion to an unprecedented $1.1 trillion. This sharp increase shows not only our growing reliance on credit, but also the economic pressures that many Americans face. And this situation looks set to worsen, with projections suggesting that total credit card debt could reach $1.2 trillion soon. And as if that wasn't enough, credit card holders are also dealing with record high interest rates. The average annual percentage rate across credit cards has hit a staggering 27.9%, adding even more pressure to consumers. These high interest rates exacerbate the financial strain for many, especially when paired with increasing debt levels. When we break down credit card debt by age, we see some interesting trends. For younger individuals, aged between 18 and 26, the average credit card debt is around $3,262. But this figure climbs dramatically among older demographics. Those in Generation X, aged between 43 and 58, are dealing with an average debt of nearly $10,000. These numbers not only reflect the credit habits of different age groups, but also highlight the broader economic challenges influencing spending and saving behaviors. These rising delinquency rates and the surge in overall debt are not happening in a vacuum. Other economic indicators are also concerning. Mortgage rates are reaching new highs, making homeownership an even greater financial burden. And then there's the potential threat of stagflation, a combination of stagnant economic growth and high inflation reminiscent of the 1970s. If inflation continues to escalate without effective intervention, we could see a return to the severe economic conditions of that decade, with double-digit interest rates on mortgages and potentially even higher rates on credit cards. Another issue we need to consider is the rise in auto insurance rates, which have increased by 22% over the past year. Auto insurance is a mandatory expense for all drivers, so this sharp increase is a significant contributor to overall inflation and complicates the financial situation for many Americans. So what have we learned today? We've looked at the troubling outlook for the U.S. economy with high credit card debt, rising delinquencies, and increasing interest rates. We've seen how these issues point to deeper underlying economic problems. As we grapple with these challenges, it becomes ever more critical to find effective economic strategies. Understanding these dynamics is key to preparing and responding to the potential long-term impacts on the economy and on individual financial well-being. It's a complex landscape, but with knowledge and understanding, we can navigate it together.